Our next guest oversees almost $80 billion in assets that they manage. He just released his outlook for 2024, saying the U.S. continues to be his preferred destination, arguing that cyclical economic trouble can always pose a risk. Joining us now at Post 9 is Wilmington Trust Chief Investment Officer Tony Roth. It's good to have you here.
Thanks for having me.
It's a relatively positive 2024 capital markets forecast. You talk about the U.S. dynamism in terms of its economy and our ability to sort of deliver economic growth and disinflation the rest of the developed world can only envy. So what does that mean from an investor standpoint?
Well, it means that from a long-term investor standpoint, the U.S. is in a super cycle right now, where when we look at the degree of labor flexibility and technology and innovation coming together, the U.S. has been able to create a set of conditions for sustained economic growth. So next year, we're going to have about probably 1.3 to 1.5% growth. And it doesn't sound spectacular, but compare that to Europe, which is probably in a recession right now. And so as we get through that period of time without seeing significant unemployment next year, we're certainly going to move into a period where we're going to have reaccelerated economic growth. And from an equity investor standpoint, where we've seen significant concentration in those 7 securities, the rest of the market is not at extended multiples. And so we're seeing that trade expand. We're seeing more breadth in the equity market. And we're seeing an opportunity to play catch-up, if you will, around those 7 names and achieve pretty attractive growth in the equity portfolio here in the U.S.
We talk a good deal about the market cap of those 7 names being roughly almost 30% of the overall S&P. It does seem a bit out of whack. But are you saying then as we head into 24 that it is the focus on the other 493 that should be sort of paramount for investors?
I think that's right. I think that the rest of the S&P is likely to catch up. That's where we would put an overweight within the S&P in context of the overall portfolio. We would not underweight those 7 names because that's where the technology is coming from. And it's really the digitalization and the AIification, if you will, just made a new word, of the rest of the economy. It's the consumption of AI on the part of the rest of the economy that's creating the productivity gains that we're seeing, which is allowing us to move forward without seeing the, if you will, the supply side labor crisis that we had a year ago. So even if wages don't come down to 2%, we can live with wages at around 3 or 4%. And it's really the productivity on the back of the technology that those 7 companies are delivering. So we don't want to underweight those 7 companies, but there's going to be a catch-up trade with the other 493, and we're already seeing that.
Yeah, that's sort of some of the bulls who are putting like 25 targets of 6,000 and earnings of 300 betting on this productivity boom. Are you looking out that far yet?
We're not. Well, maybe if we're looking out that far, we're looking at 3 years.
Yeah.
But I think that the opportunity right now is to be market weight in large cap and look for a better entry point. Because when you consider what's happened over the last few months, we've seen 2 big inflections in the market. And they haven't come from the Fed. They haven't come from earnings. They've both come from the Treasury Secretary. So if you recall back in October, the Treasury Secretary came out and disappointed markets with a forecast initially for far more on the back of the debt ceiling issue, right, far more Treasury issuance to refund the general account. And that caused the market to sell off. Then we had the opposite occur in the beginning of November, where she said we were only going to issue about $800 billion or so in the first quarter of next year. That was really the genesis of the recent rally.
Right.
There's a lot of opportunity for her to disappoint again as we get into next year with a bigger deficit than expected.